Hi, my name is Brandon Daniels, and today I will be talking about the week from April 22nd to Friday, April 26th. And basically, I'll be talking about how the yield curve changed based on the effects throughout the economy. From Monday to Friday, the yield curve dropped slightly, the lower for the week, with majority of movement coming later, which is on Friday. The yield from Monday to Friday fell, and the reason I felt that the drop was affected by the drop was the 15-year fixed mortgage rate, which fell to its lowest level on record. With such low rates, they became highly sought after by those who qualified for the loans. The fixed mortgage rate fell to 2.615, which is 0.03% lower, dating back to 1991. It was originally 2.63%, with the low obtained last November. Tom Jones, a broker with Prudential Snyder Real Estate and the president of Bloomington Normal Realtors Association, said the low rates are encouraging people to buy more. While mortgage rates are flattened, once people began to commit to these rates, you notice the yield began to steepen. Moving on to the interest rates from Monday to Friday, based off the interest rate forecast in Bloomington.com, to control market mortgage rates, the Federal Reserve went into and began purchasing Treasury bonds, which had proven to help the Treasury yield. Many have begun to fear that the U.S. and the global economy are lacking and have inadvertently forced investors to dump money into safer assets such as treasuries, and staying away from the stocks. As you can see on the yield curve here, that from Monday to Tuesday, watching the market, I saw the experience a bit of a fret with a fake tweet of so-called explosion that was posted on the Associated Press Twitter website. Later, so that began to spook investors. But later, the Associated Press came out and issued a statement saying that their Twitter account was hacked. So that was the reason for a lot of the pullout. So to kind of balance that pullout out with the 0.25% loss, once many speculations of terror and false accountants were accounted for, the Census Bureau issued a statement also saying that the real estate industry grew up 1.5%, and 10-year Treasury notes declined by 1 basis point. Meanwhile, strong earnings and positive reading on the housing market overshadowed the gloomy news, allowing the industry average to end up closing 1% higher. As you can see, from Monday to Tuesday is slightly higher. So basically they bounced back. For Tuesday and Wednesday, the rates remain relatively the same, with little to no visual change. I mean, as you see, it's probably outlined a little bit, but it was barely, if any, change at all. With most of the changes coming out in the middle was just 0.05%. In the end it ended with a high of 0.13%. According to the Guardian finance analyst Dominic Rush, Apple invested $100 billion back to shareholders and encountered high-profile borrowers. The total bond offering size has yet to be determined, but has speculation of a huge loss coming towards the week's end, Thursday, Friday. In watching the yield curve for Wednesday through Thursday, I noticed it finished with little to no change. But it seemed as though that the maturities cut their losses early with a starting rate of negative 0.43%. U.S. stocks closed slightly higher, as investors digested a better-than-expected jobless claim. With a flurry of up and down earnings, shook the market early in the day. As you can see, it kind of started off pretty much even. According to WorldPress.com, the complex slipped in overnight trade as global equity markets climbed higher, but crossed back into the positive territory after disappointing data. The trade drifted into the afternoon hour, holding little change. Although bonds were unchanged, they saw little to no change. As they were generally bought up, it caused the yield to drop slightly in the beginning. Now you see, as my research stated earlier, that the changing of the most significant change in the market occurred at the end of the week, Thursday to Friday. As you can see on the screen, it severely flattens. Companies such as Apple noticed this change and figured to try to help the curve as much as possible. So they went ahead and plunged billions of dollars back to shareholders, where they plan to come out and have shareholders paid out by the year 2015. And the federal government also went in and began dumping money into bonds and securities, hoping to bring back up mortgages, predicting to help it steepen the curve back up to a stable state. So this is my report for the week of April 22nd. I would like to thank you for listening. Once again, my name is Brandon Daniels. Thank you.